Hello, friends. Last year, Congress approved a law that provides Americans aged 65 and older with a major tax benefit worth up to $6,000 for an individual or as much as $12,000 for a married couple. This is not a rumor, and it is not speculation. The IRS has confirmed it, and eligible taxpayers can take advantage of it right now through the year 2028. The challenge is that many people have heard bits and pieces about this deduction, but still do not fully understand how it works, whether they qualify, or what steps they need to take in order to receive the benefit. Even more concerning, a large number of Americans already filed their 2025 tax returns without claiming it at all, leaving money unclaimed that may still be recovered. In today's video, I'm going to walk you through everything in a simple and practical way. We're going to cover what this deduction actually is, who can qualify for it, how to claim it correctly, and what actions you should take if you've already filed a return and missed it. No confusing tax jargon, no complicated explanations, just the information you need and the steps that matter. Before we begin, make sure you subscribe to the Frank American and turn on notifications. This channel is dedicated to helping everyday Americans understand not only the headlines, but also the practical details that can put real money back into their pockets. Subscribe now, and let's get started. First, let's talk about exactly what this benefit is and how it works, because the word deduction often causes confusion. I want to make sure everyone understands what they're actually receiving. A tax deduction lowers the amount of income that is subject to federal taxation. It is not a government check arriving in your mailbox, and it is not an increase to your monthly Social Security payment. Instead, it reduces the amount of income the IRS uses when calculating your tax liability. When that taxable income goes down, the amount of tax you owe can go down as well. In some situations, it can reduce your federal income tax bill all the way to zero. The legislation known as the One Big Beautiful Bill, which became law on July 4th, 2025, created a brand new deduction specifically for Americans who are 65 years old or older. The value of this deduction is $6,000 per eligible person. If you are married and both spouses are at least 65 years old, the deduction doubles to $12,000 total, with each spouse receiving a $6,000 deduction. This benefit applies to tax years 2025 through 2028, giving eligible seniors 4 years to take advantage of it. Unless Congress decides to extend provision, it is currently scheduled to expire after 2028. To qualify, you must be at least 65 years old by December 31st of the tax year in question. You must also have a valid Social Security number. In addition, your modified adjusted gross income, often very close to total household income for many retirees, must remain below certain limits. For single filers, the threshold is $75,000. For married couples filing jointly, the threshold is $150,000. Once your income rises above those levels, the deduction begins to phase out gradually. The deduction is completely eliminated once income reaches $175,000 for single taxpayers and $250,000 for married couples filing jointly. If your income falls somewhere between the starting threshold and the cutoff point, you may still qualify for a reduced deduction. That makes it worthwhile to calculate your eligibility rather than assuming you don't qualify. There's another important detail that often causes confusion. This new deduction is not the same as the additional standard deduction that seniors have been receiving for years. The existing senior deduction remains in place. In 2026, that deduction is $2,050 for single filers and $3,300 for married couples. The new $6,000 deduction created by the OBBB law is separate and is added on top of the existing benefit. In other words, these deductions work together rather than replacing one another. This is where the impact becomes truly meaningful for millions of retirees, and where many people have not yet realized the full value of the benefit. In 2026, a single taxpayer can earn a certain amount of income before any federal income tax is owed. That amount is determined by combining all available deductions. For a single senior, the numbers look like this. The standard deduction available to all taxpayers is $16,100. The additional deduction available to seniors is $2,050. The new OBBB deduction contributes another $6,000. When you combine those three amounts, the total reaches $24,150. That means a single taxpayer age 65 or older can earn up to $24,150 during 2026 before owing any federal income tax at all. For married couples where both spouses are age 65 or older, the numbers become even larger. The standard deduction is $32,200. The existing senior deduction adds another $3,300. The new OBBB deduction contributes $12,000. Together, those deductions total $47,500. As a result, a married couple could earn up to $47,500 before facing any federal income tax liability. Now consider what this means in the context of Social Security benefits. The average Social Security retirement benefit in 2026 is approximately $2,081 per month, which equals about $24,972 annually. For a retiree receiving a benefit close to that national average, nearly all of that income falls within the protection created by these deductions. For millions of middle-income retirees, the result is straightforward. Their federal tax bill on Social Security income could be reduced all the way to zero. Not simply reduced, a complete elimination of federal income tax liability, because the available deductions absorb the taxable income. Even retirees who receive income from other sources can benefit significantly. Someone collecting Social Security while also receiving a small pension, working part-time, or earning modest investment income may still remain under the deduction threshold. For example, a retiree receiving Social Security benefits plus $1,200 in annual interest income would still remain comfortably within protected range. This deduction delivers the greatest value to middle-income Americans. It is designed for people who are not wealthy enough to ignore tax changes, but who earn enough income that taxes still matter. These are the hard-working Americans who spent decades contributing to the system and are now relying on the benefits they earned throughout their working lives. That brings us to the question many people are asking. What do you actually need to do in order to claim this deduction? For tax year 2026, which most taxpayers will file during the early months of 2027, the process should be relatively simple. When you indicate your age in your tax preparation software, the deduction is expected to be applied automatically for eligible taxpayers. The IRS created a new form known as Schedule 1A specifically to handle this deduction. By the next filing season, most major tax software providers are expected to include automatically, meaning many taxpayers won't need to take any additional action. The bigger issue involves 2025 tax returns, the returns that many Americans already submitted earlier in the year. Tax year 2025 was the first year this deduction became available. And because it was brand new, many taxpayers filed before they fully understood the rules. Others used software that had not yet been updated with the latest changes. As a result, countless eligible seniors may have filed their returns without claiming the deduction they were entitled to receive. Some taxpayers relied on professional preparers who were still learning the details of the new law as it was being implemented. According to tax attorneys and certified public accountants, many individuals who filed in January, February, and the first part of March submitted their returns before they fully understood the new Schedule 1A requirements and how the deduction was supposed to be claimed. If you already filed your 2025 tax return and Schedule 1A is not included in your paperwork, there's a strong possibility that you missed out on money that rightfully belongs to you. The good news is that there is a solution. The IRS allows taxpayers to correct mistakes by filing Form 1040-X, which is the amended return form. This does not mean you need to prepare your entire tax return all over again. Instead, you only update the portions of the return that are changing. You attach Schedule 1A showing the eligible senior deduction of either $6,000 for an individual or $12,000 for a qualifying married couple, and then submit the amendment to the IRS. In most cases, the IRS processes amended returns within roughly 16 weeks. You also have plenty of time to act. The deadline for amending a 2025 return and claiming any refund you may be owed is April 15, 2029, which is 3 years after the original filing deadline. While there is no need to panic, filing sooner rather than later generally means receiving any refund much faster. So how can you tell whether you missed this deduction? Start by pulling out a copy of your 2025 federal tax return. Review the documents and check whether Schedule 1A is included. If it is not, that's your first warning sign. Next, look at the total deductions reported on your Form 1040. For a single taxpayer who is age 65 or older and whose income is below $75,000, the correct deduction amount should generally reflect all three layers combined. That means the standard deduction, the existing additional deduction for seniors, and the new OBBB senior deduction should add up to at least $24,150. If your return shows deductions totaling only $18,150 or less, there's a good chance the additional $6,000 deduction was never included. In that situation, filing an amended return may allow you to recover money that was left behind. There's another aspect of this law that deserves attention because it creates a planning opportunity that many discussions completely overlook. Most videos focus only on the deduction itself. Very few talk about how it may affect broader retirement tax planning over the next several years. Financial planners have pointed out that retirees who own traditional IRA accounts may want to take a closer look at whether the years between 2025 and 2028 represent a favorable period for larger withdrawals than they would normally consider. Here's why. Money withdrawn from a traditional IRA is generally treated as taxable income during the year it is taken out. Because of that, many retirees try to keep withdrawals as low as possible in order to reduce their tax burden. However, the new senior deduction changes the equation. Right now, eligible retirees have access to an additional $6,000 deduction or $12,000 for qualifying married couples. Since that deduction lowers taxable income, it can effectively reduce the tax impact of IRA withdrawals made during this period. In simple terms, a withdrawal taken while the deduction is available may cost less in taxes than a similar withdrawal made after the deduction expires in 2029. This becomes especially important for retirees who expect future required minimum distributions or who have accumulated substantial balances in traditional IRA accounts. The 4-year period created by this law may provide opportunities that are worth evaluating carefully rather than waiting until the deduction disappears. The same concept can apply to Roth conversions. A Roth conversion involves moving money from a traditional IRA into a Roth IRA.